Welcome back to the Global Ledger. I'm Justin. Today, we're tackling a concept that most investors think they understand, but almost nobody truly sees through the lens of funding, liquidity, and balance sheet mechanics. It's credit spreads. Credit spreads are treated like a simple risk premium in some textbooks, but in the real world, credit spreads are a funding signal, liquidity, collateral signal, dealer balance sheet signal, and sometimes a stress signal. So far from being just a gauge of creditworthiness, credit spreads tell us how the entire financial system is breathing. Let's get into it. So let's go through the textbook explanation. So the standard explanation is credit spreads compensate investors for default risk. So meaning a company might fail, a bond might not pay. Investors demand extra yield to be compensated. So, and again, that's not wrong, but I'd argue it's incomplete and dangerously incomplete because credit spreads move every day, but default probabilities do not. So why do spreads change constantly? Because spreads are really about the cost of holding, funding, hedging, and warehousing credit risk. So not just the probability of default. So to really understand spreads, we have to look at markets the way a dealer would. So let's look at a dealer view of credit. So think of a dealer making a market in, say, corporate bonds. So to quote a bond, the dealer must buy it. He has to fund it. They have to hedge it, warehouse it, which means put it on their balance sheet, and take the risk that it may move in price. So that entire process requires repo financing. It requires balance sheet capacity, collateral, and it requires to hedge liquidity in say CDS or related markets. So the spread on a corporate bond is not just about credit risk. It's also about the dealer's cost to carry the position. So I would say credit spreads equal credit risk plus funding costs, plus liquidity costs, plus hedge costs, and plus balance sheet costs. So this is why spreads tighten when funding is cheap and liquidity is strong. Hedges are available and the dealer's balance sheet is open. So and spreads widen when the opposite tends to happen. So you don't need a new recession forecast for spreads to widen. You just need tighter funding. So let's talk about why liquidity drives spread cycles. So most investors look at credit spreads as an economic indicator or a recession predictor. But I think it shows us that spreads are also a liquidity indicator. So here's how that process works. So when liquidity is abundant, and we've talked about this before, repo is cheap or cheaper. Dealers can fund credit positions with ease, and spreads seem to tighten. So and again, the inverse is true. When liquidity dries up, repo can become more expensive. Dealers may want to shrink their balance sheets, and spreads, of course, widen. And this is why spreads widen so dramatically in 08, 11, 2020, and 2023. So not because default risk suddenly skyrocketed, but because funding markets froze. So brings us to kind of our next topic or part of this conversation, where credit spreads get hedged. So another overlooked component is the credit default swap market. This is CDS for short. So this is the hedge for credit risk, and it's a huge market. So from a dealer's perspective, bonds are hard to short. CDS is easy to short and cheaper to hedge with. So CDS affects cash bond spreads the same way. So if CDS liquidity weakens, you'll see spreads start to widen. If CDS liquidity strengthens, you'll start to see spreads tighten. If hedging, say, gets more expensive, then you'll see those spreads widen. And if hedging becomes cheap, then spreads tighten. So this is why spreads sometimes widen, even when the economy is fine, because the cost of hedging changes, not the company's fundamentals. So we're talking about liquidity, and I think it would be a good time to bring in the global dollar liquidity link. And we've touched on this already, but credit spreads also widen when dollar liquidity tightens internationally. So when the dollar strengthens, hedging U.S. dollar liabilities becomes more expensive, and also foreign investors reduce credit buying, and you'll see just a widening in global spreads. So this is why emerging market spreads blow out, even when their fundamentals really haven't changed. Credit spreads reflect global dollar conditions, not just local economics. Let's connect this up with valuation and talk about the risk premium component. Remember, the equity risk premium often moves with credit spreads, volatility, and liquidity conditions. And the reason that is because when credit spreads widen, the price of risk everywhere else rises. So this shows up in higher discount rates and lower valuations and the slowing of deal flow and tighter lending standards, or tighter lending, I should say, and really just a collapse of risk appetite. So credit spreads act like a signal that the system is demanding more compensation to bear risk. So this is why spreads lead, I think, stock market volatility. They are cleaner, a more structural signal. So this view of credit spreads can remove some of the uncertainty of it, and so you stop thinking that markets are irrational, and you start to realize the spreads reflect funding, not just fear. So you stop misinterpreting spread noise as economic collapse. Really important. So understanding spreads helps you navigate markets like a dealer would, instead of a headline-driven investor. So thanks for listening to episode 17 of the Global Ledger. Today, we reframed, it looked at credit spreads differently, just from a simple risk premium to a full picture of funding, hedging, dealer capacity, and liquidity conditions. So in episode 18, we're going to connect credit spreads directly to inflation dynamics, and we'll talk about kind of the balance sheet mechanics of inflation. So you won't hear inflation explained like this anywhere else, I hope. Once again, I'm Justin, and thanks for being here.